Welcome to the TAC Index AI podcast, July 8th, 2026, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo. So in today's deep dive, we are unpacking this glaring market paradox.
Yeah, it's a fascinating situation right now.
It really is. I mean, right now, jet fuel prices are plummeting, yet airlines are posting record profits while passenger tickets stay historically expensive. And, this massive disconnect is just completely scrambling the global freight map for you and the broader macro economy.
Exactly. And the latest Baltic air freight index, the BA, really illustrates that disconnect. Global rates actually dropped 2.7% week over week.
Okay, so the low in jet fuel prices from the Gulf ceasefire are finally feeding through.
Yeah, they're finally feeding through to average shipping costs.
Yeah.
But, well, the baseline remains really elevated. We are sitting 27.7% higher year over year.
Wow. And the regional breakdown is where, the logic just completely fractures. Shanghai outbound dropped 6%, right?
Right. And London Heathrow is down 11.5%.
So it's like a global freight seesaw. If those major hubs are cooling off in tandem with cheaper fuel, the underlying math should apply globally. So if global supply chains are cooling down with fuel prices, why is the U.S. market acting like a lone wolf and surging?
It's wild, I know.
Chicago outbound rates just jumped 10.1%.
Yeah, that localized pressure in Chicago is driven by demand severely outstripping available lane capacity to Europe and Southeast Asia.
Wait, really? Is there a shortage of planes?
No, the bottleneck isn't about a lack of physical aircraft.
Yeah.
It is tied directly to how legacy carriers are managing their passenger networks right now to, maximize margins.
Which ties directly to the extreme fuel volatility we've tracked since spring. Because back in May, due to the Iran conflict, U.S. airline fuel bills jumped 85%, right?
Yeah, up to $6.7 billion.
Right. But since that April peak, jet fuel has plunged 40%. So here's the discrepancy for the listener. If jet fuel prices are plummeting, why are passenger airfares staying sky high while air cargo rates get a discount?
Well, it comes down to a capacity crunch and really resilient consumer demand. The airlines learned a harsh lesson during that fuel spike and trimmed their less profitable routes to preserve capital.
Right, makes sense.
But now that fuel is cheap again, they just haven't added that capacity back.
Huh.
And the recent bankruptcy of Spirit Airlines plays a mechanical role here, too.
Oh, because they were the discount option.
Exactly. While Spirit operates narrow-body domestic flights, their absence alters the entire capacity math for legacy carriers. Without a budget airline undercutting fares on domestic feeder routes, well, legacy carriers face zero pressure to compete on price.
So they just keep passenger fares high and restrict their overall network expansion.
Yeah. And by holding back on adding flights, they also withhold the wide-body international belly space that would normally relieve the cargo congestion.
Which is causing that 10% rate spike out of Chicago.
Right. They're artificially constraining supply across their entire network.
So they essentially pocket the 40% drop in fuel costs rather than passing those savings on to the consumer or, expanding schedules.
Yeah, they'd rather retain the higher fares. And Wall Street is clearly rewarding that margin management. Airline stocks are hitting record highs right now.
Because they're trading inversely to crude oil.
Exactly. We saw Delta and United hit records in late June, just as fuel costs bottomed out. The logistics sector is currently outperforming traditional market drivers.
Which is such a stark contrast to the broader S&P 500. That just saw a dip driven by volatility in the AI chipmaker space, right?
Yeah, companies like Samsung and Micron experienced sell-offs despite strong earnings. The growth expectations baked into their valuations were just unsustainable.
So the legacy transportation networks are delivering the reliable profit margins that the tech sector is suddenly struggling to guarantee. But, that reliance on restricted capacity feels like a highly fragile equilibrium.
It absolutely is. It hinges entirely on consumer endurance. Airlines are betting that you, the traveler, are willing to just absorb those premium fares indefinitely.
Which brings us to something provocative to ponder. What happens after Labor Day?
Oh, that's the big question.
Right. If passenger leisure demand drops in the fall, will airlines suddenly flood the market with the capacity they've been withholding?
And if they do, that could trigger a massive passenger price war.
Exactly. And that sudden influx of cheap international belly space could radically disrupt global air cargo logistics overnight. Definitely something for you to monitor as we head into the autumn shipping season. Until next time.